Something impossible is happening right now in financial markets. And if you don't see it, you're about to lose a decade of gains. Every asset class is overvalued simultaneously. Stocks at record highs, real estate at record highs, bonds at record lows in yield, commodities inflated, crypto inflated, even art and collectibles inflated. For the first time in history, there's nowhere to hide. Everything is expensive. Everything is in a bubble. And when everything is in a bubble, the pop doesn't spare anyone. Let me show you something that should terrify every investor: the Buffett indicator. It measures total stock market value against GDP. It tells you if stocks are cheap or expensive relative to the actual economy. The long-term average is 100%. Stocks worth about the same as annual economic output. In 2000, before the dot-com crash, it hit 140%. Stocks were 40% overvalued. They crashed 50%. In 2008, before the housing crash, it hit 105%. Close to fair value. Stocks still crashed 50% because of the financial crisis. Today, the Buffett indicator is at 187%. Stocks are valued at almost twice the annual economy, the most overvalued in recorded history. Not by a little, by a lot. This isn't debatable. It's math. And Warren Buffett himself, the man the indicator is named after, is sitting on $334 billion in cash. He's not buying stocks, he's selling and holding cash, waiting for the crash he knows is coming.
But it's not just stocks. Real estate is equally insane. The median home price in America is $420,000. The median household income is $75,000. That's a ratio of 5.6 to 1. Historically, it averages 3.5 to 1. Homes cost 60% more relative to income than the historical norm. That's not sustainable. It's a bubble, and it's already popping. Home sales down 22% year over year. Inventory building, prices starting to crack. The data says we're at the beginning of a 20 to 30% decline in home prices, just like 2008. Bonds are in a bubble too. Governments and corporations issued trillions in bonds at near zero interest rates during the 2010s. Those bonds are now worth far less because interest rates rose. If you bought a 10-year treasury at 1% interest in 2020 and you need to sell it today when new 10-year treasuries pay 4.7%, you take a massive loss. The bond market has lost $3 trillion in value since 2021. That's more than the stock market crash of 2008. And most people don't know what happened because bond prices aren't on TV every night.
Crypto is in a bubble. Bitcoin hit 69,000 in 2021, crashed to 15,000 in 2022, now it's back to 60,000. The volatility alone proves it's not a store of value, it's speculation, pure price momentum driven by hope that someone will pay more tomorrow. And when risk appetite disappears, when fear returns to markets, crypto crashes hardest, every time, no exceptions. Even collectibles are in a bubble. Art, wine, classic cars, NFTs. During easy money eras, people buy things that have no cash flow, no earnings, no dividends, just the hope of selling to a greater fool. That's the definition of a bubble. And all these asset classes are correlated now. They all go up together, which means they'll all go down together. And that's what's starting to happen. The mechanism that inflated everything is breaking. For 15 years, central banks printed money, suppressed interest rates, pushed investors out of safe assets like bonds into risky assets like stocks and real estate. It was called the wealth effect. Make people feel rich by inflating asset prices. They'll spend more. The economy will grow. Except it didn't work. The economy didn't grow faster. Productivity didn't improve. GDP growth averaged 2% despite trillions in money printing. All that happened was asset price inflation. The people who owned stocks and real estate got rich. The people who didn't got left behind. Inequality exploded. And now the mechanism is reversing. Central banks stopped printing, raised rates, and asset prices are starting to deflate. But here's the problem. The entire financial system is built on inflated asset values. Banks hold trillions in bonds that are underwater. Pension funds need 7% returns to meet obligations, but bonds pay 4%. Insurance companies promised payouts based on assumptions that no longer hold.
When asset prices fall 30 or 40%, which they will, these institutions face insolvency. And when institutions fail, the system freezes. Credit disappears. Businesses can't borrow. Consumers can't spend. The economy crashes. This isn't theory. It's what happened in 2008. And it's setting up again. Bigger, broader, more interconnected. Let me show you the timeline. We're in stage 1 right now. Asset prices at peaks, cracks starting to appear, volume declining, volatility increasing, smart money exiting. Stage 2 begins when something breaks. A bank fails, a country defaults, a major company goes bankrupt. That triggers fear. Fear triggers selling. Selling triggers margin calls. Margin calls trigger forced liquidation. Stage 3 is cascade. Prices fall 10%, then 20%, then 30%. Institutions face insolvency. Central banks intervene. But the intervention doesn't work like it did before, because the problem isn't liquidity, it's solvency. Assets are genuinely overvalued, and no amount of money printing can change that. Stage 4 is capitulation. Prices fall 50%. Everyone who can sell has sold. Retail investors are wiped out. And that's when stage 5 begins. The smart money buys. Buffett deploys his $334 billion. Distressed funds buy real estate at 40 cents on the dollar. Private equity buys companies for fractions of value. The wealth transfer happens, from the unprepared to the prepared.
We're in stage 1, moving towards stage 2. And most people don't see it because asset prices are still high, stocks near record highs, real estate holding up. But the internals are breaking. Breadth is weak. Most stocks are down even as indexes stay elevated. Credit spreads are widening. Default rates rising. The foundation is cracking. The question isn't if the bubble pops, it's when. Before I show you how to position for this and what assets will survive, I need you to subscribe immediately. Because what's coming isn't just a correction, it's a complete reset of asset values back to historical norms. Stocks will lose 50%, real estate 30%, bonds already lost trillions. And when this happens, 90% of investors will panic and sell at the worst possible time. But the 10% who understand what's happening will position to profit. Subscribe right now so you're in the 10%. Turn on notifications because stage 2 could begin any day, and when it does, everything moves fast.
This is what you need to understand about bubbles. They always pop. Always. Without exception. The South Sea bubble in 1720, Tuliprania in 1637, the dot-com bubble in 2000, the housing bubble in 2008. Every single time, assets became overvalued. People convinced themselves this time was different. And then reality returned with violence. The everything bubble is no different. The only question is, what triggers it? Maybe it's a bank failure. Maybe commercial real estate defaults cascade. Maybe a geopolitical event. Maybe just exhaustion as buyers disappear. The trigger doesn't matter. The outcome is mathematical. When assets are 50 to 80% overvalued, they eventually return to fair value. That's not pessimism. That's reversion to the mean. And it always happens. The wealth transfer that follows is the real story. In 2008, millions lost homes, jobs, savings. But a small group made fortunes. They bought real estate at 30 cents on the dollar,
stocks at garage sale prices, and generated returns that created generational wealth. The same opportunity is building now, but you have to see it coming, have to prepare, have to have cash when everyone else is forced to sell. This isn't about timing the market perfectly. It's about recognizing we're in a bubble. Everything is expensive. The risk-reward is terrible at current prices. And cash, boring cash, is the best position until fear creates opportunities. Here's what I'm doing, and I'm not giving financial advice, but I'm sharing what makes sense to me. Holding 40% cash, waiting for the drop, avoiding overvalued assets, stocks trading at 30 times earnings, real estate at 5.6 times income, bonds with negative real yields after inflation. These aren't investments, they're traps. And I'm not walking in. I'm waiting, patiently, for stage 5, when fear is maximum, when prices are 50% lower, when everyone has given up. That's when I'll deploy the cash. If you understand this, if you see the everything bubble, if you're preparing instead of hoping, then subscribe right now. Share this with anyone who's all in at these prices, and comment below telling me what you think pops first. Stocks, real estate, bonds? Because we're watching the greatest bubble in history deflate, and those who see it clearly will benefit enormously when it finally bursts.